it's Bob Huebscher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Across the U.S. wealth spectrum, 2 out of every $3 in investable assets are in taxable accounts. Having a comprehensive tax management strategy is critical in the context of separately managed accounts. Tax loss harvesting is one component of a tax management strategy. Tax efficient or tax aware portfolio rebalancing is a key part of that. That includes the ability to evolve or rebalance the portfolios periodically in a tax efficient manner by minimizing the overall tax liability. The tax efficient techniques involve pairing gains against losses or avoiding short term gains in favor of long term gains or capping gains in general to minimize overall tax cost. And my guest today is here to talk about tax loss harvesting. He is Manju Boraian. He is a senior portfolio manager and the head of Systematic Edge Fixed Income and Custom SMA Investments for the Systematic Edge team at Allspring Global Investments. So, Manju, let's start out by telling me about your career path, what led you to Allspring and your role there.
Absolutely, Bob. Great to be here with you. Thanks for having me on the show. So in terms of my career path, Bob, so I graduated from Stanford with a degree in computational mathematics. I wanted to go into finance. I was really passionate about applying maths in finance. So my first job out of school was to really work for Barclays Global Investors back in the day. I was one of the founding members of their emerging market debt team. And the role I played there was to really leverage quantitative techniques to build up hedge fund strategies to invest in EM. So it was a fascinating, first few years, learning from the best and the brightest at BGI. And from there, I went on to, we became BlackRock. From there, I went on to Goldman, and then, did a startup with some ex-BGI colleagues. Then I was running hedge fund strategies at State Street Global Advisors. And I came here, at Wells Fargo Asset Management prior to it becoming Allspring in 2019 of April. And my mandate was to kind of build out the systematic fixed income team in the business, focused on active and passive fixed income strategies. And along the way, I also picked up the custom SMA business as we built a platform called Remy to do customized tax efficient solutions in a scalable fashion. So we launched that in March of 2021. So fast forward to today. So I basically lead the systematic fixed income team, focused on active and passive fixed income strategies, and then also the custom SMA team, which is focused on all retail manager traded SMA strategies.
Let's go back and tell me what the origins of tax efficient investing were and how that fits into custom SMAs at Allspring, and how has that impacted where you are today with the Remy offering that you just mentioned?
Sure. Yeah. So if you think about the origins, I think you have to kind of think about it in the context of the different vehicles that are available for retail investors, right? So you have the mutual fund structure, you have the ETFs, and then you have the separately managed accounts. And as you know, I think the most tax efficient vehicle out of the three is definitely the separately managed accounts, because you can hold the individual assets in kind, right? So be it bonds or equities. And the benefit of doing that rather than being held in a commingled structure is that you can essentially, when there are gains or losses, you can harvest them and do it much more efficiently. So SMAs in general are much more tax efficient because you can maximize tax efficiency by applying tax management strategies there. Now, that has actually taken a huge leap over the last few years, because the concept of building and managing these in a customized fashion and applying tax management across thousands of accounts has become a lot more easier with some of the advances in technology that we've seen. So, which is the reason why tax efficient or customized SMAs have become more, adoptable in the mainstream over the last, call it, decade or so, and they've kind of regained prominence and has become the vehicle for the future, in my view. Now, in terms of how Allspring got into it, we got into it because there was a problem that we were trying to solve for one of our affiliates then, Wells Fargo Advisors, who were looking to essentially transition about 200 billion in assets in a tax efficient fashion to customized solutions. And we were trying to work with them to design solutions. And we ended up actually building something in house to help them do it in the muni space, then expanded to taxable fixed income and equities. So it's been a long road, but it's been an exciting one for us. We always had a SMA business at Allspring, more on the manager traded SMA space, but really building out more on the model delivered SMA space, but building out the manager traded SMA space really required a platform and capabilities that could help us do customization tax management at scale. So that's really been kind of the road for us over the last 2.5 years.
Tax loss harvesting is traditionally thought of in terms of equities, but I know that you've done a lot of work on the fixed income side as well. Has that become a priority for your clients?
It is, and what we have seen, Bob, is it's definitely a lot more easier to do it in the equity space. It's a lot more efficient asset class. On the fixed income side, I would say we are one of the early providers in that space, along with a few other competitors. And the reason it's gaining prominence, especially in the fixed income space, is it's definitely complex, especially fixed income. If you look at munis, there are a million CUSIPs that are outstanding, and about 50,000 issuers in that space. And the broadest benchmark has about 60,000 bonds. So it's a fraction of what's out there. And ultimately, when you're building a portfolio, you have to pick about 20 or 40 bonds and build a diversified portfolio. So portfolio construction itself is quite hard in fixed income to begin with, especially when it comes to SMAs. And then on top of that, when you have to do tax efficiency or tax management, you require essentially a scalable investment platform. So not many providers have that. So starting with that basic platform and really building on top of that is really critical. So, from my perspective, I think we are in the early stages, especially in the fixed income space, when it comes to direct indexing, being able to build customized tax ladders or tax efficient ladders, and doing it, consistently in a scalable fashion across different, wealth spectrum clients, requires you to really have a scalable platform. So that's really where we see an advantage. And one of the other differentiators for us is we're not trying to just do it purely systematically. We also leverage our fundamental research to pick issuers, which really gives us better way of assessing credit and building more efficient portfolios. So we have kind of blended the two, like the fundamental research piece and then systematic portfolio construction to do this in a much more efficient fashion in fixed income.
What does your research show in terms of the benefits that accrue to clients through tax loss harvesting, and which clients benefit the most?
Yeah, no, it's a great question. So if you look at it, definitely it benefits folks who are ultra high net worth and high net worth because their portfolios are more complex and they have definitely more realized gains and losses just given the scale, and where they invest in. If you look at the portfolios that are held by the kind of the lower end of this world spectrum, they're investing in ETFs. If you look at their asset allocation mix, they're more invested in ETFs and mutual funds. So I would say it's definitely more beneficial to the high net worth and ultra high net worth individuals. But I would argue that tax efficiency and tax management is an evergreen strategy that should be applied across all retail, kind of managed strategies. So from that perspective, there is efficiencies to be gained even for a smaller size portfolio. But it's just that it's not going to be material like the way it would be when you look at a large size portfolio. So our minimums in SMA is pretty low, right? Our muni ladder minimum is $150,000. So if you're building a ladder portfolio, with just $150,000, you can still manage it more tax efficiently and maximize the after tax returns for investors. But it does, vary quite a bit as you kind of go down the wealth spectrum. I would say the more efficiency is definitely realized in the upper echelons of the wealth spectrum.
Direct indexing has taken off through the customization of a passive index around tax exposures or client specific goals, such as sustainable investing or an investor's unique risk profile. But I know that Allspring is also applying those techniques to actively managed products. What's attractive about that, and what are the technical challenges involved in building out that active management capability?
We are planning to do that in the actively managed strategies as well, Bob. So that's definitely our plan for next year. So the challenges in the active space is, especially if you look at an equity portfolio, in an actively managed equity portfolio, you're probably holding around anywhere from 40 to 80 names compared to 200 or 300 in a passively managed portfolio, like a direct indexing portfolio for S&P 500. So you have essentially the breadth is lower, right? So you have less names to to harvest losses from, because of the lack of breadth. You are essentially looking to your opportunities to harvest losses is definitely minimal. So that's one. And the other one is when in an actively managed strategy, when you sell something that is at a loss, you have to replace that with a commensurate security, not just from a risk perspective, but also it needs to fit into that investment acumen, right? So now, if you're managing a value-based strategy, when you sell out a name, you have to replace that with another name that has an, equally interesting value proposition. So that's the challenge. So for that, what we are doing is essentially creating something like a focus list, which is basically actively managed by the team. And the idea is when you sell out of a security, if the replacement would come from that focus list that's actively managed by the investment team, and if we can't find a replacement there, then we'll go out and find a replacement from the index. So that's one challenge, is to really kind of design this in a much more thoughtful way. On the fixed income side, it's actually quite more interesting, is because there, if you look at an actively managed SMA, it's a combination. In our case, it's a combination of like no fee mutual fund plus some individual securities that we hold to complete the portfolio. So there, we're trying to harvest losses from both sides. If you're looking to sell either the mutual fund shares or the individual securities to harvest losses, so there's decision that needs to be made in terms of what comes first. And then even within individual securities, you have to pick the more efficient ones like treasuries or corporates to sell and realize losses, rather than doing it through agency MBS, for example, if it's a core plus portfolio. So the investment design is really critical in my view when you're managing active strategies, and you need to get that right to be able to maximize tax efficiency.
So I understand how it works in the equity space with the wash sale rule. Go over some of the implementation details when it comes to the fixed income space. How do you manage direct indexing there?
Yeah, in the fixed income space, in the muni space right now, we are actually working towards actually swapping one bond to another bond. Essentially, what you need to do is when you sell out of a security, currently we actually hold an ETF for 30 days, and then sell out of that to buy another bond, to avoid the wash sale rule. But we are working towards essentially selling out of a bond and turning around and buying another bond in the muni space. So that requires us to be able to add constraints in our process, which will prevent us from buying the bond from the same issuer with similar characteristics, right? So that's really kind of what we're working towards. But the current process involves us holding an ETF for 30 days. Now, we can also do this in corporates much more efficiently because, on the corporate side, we don't actually hold an ETF. We can sell out of a corporate bond, put a restriction in for that issuer, and then go out and source another bond from another issuer with similar characteristics. So I think it's kind of like two different processes right now, one for munis, one for corporates, but we are trying to harmonize the process with munis to be very similar to the one we use for corporates. So that's it's kind of the direction of travel for us. But I would say that if you can automate this, which is kind of what we've done on the corporate side, this becomes a lot more efficient and scalable, and you can consistently apply it across thousands of accounts, right? So without breaking any wash sale rule.
Separately managed accounts breaks down between those that I believe are manager held versus those that are model based. The model based ones are implemented on advisor platforms.
Right.
Explain that difference, and do you believe that one of those approaches will ultimately prevail?
Yeah, I would say if you look at the SME ecosystem, about I would say about 30% of that is currently in model delivered SMA, and the other 70% is in the manager traded. Now, the model delivered SMA is mostly, if you look at all the strategies in there, it's mostly actively managed equity strategies. Is what really is that's a significant chunk of that model delivered SMA space. You do have some fixed income strategies in there. It's pretty tiny. The reason it's hard to do model delivery and fixed income is on the advisor platforms when a model is delivered to them, they need to be able to replicate it across thousands of accounts. So being able to buy a bond, uh, you know, uh, that's in the model and source it at the same, size and kind of like weight, I would say, and then apply it across thousands of accounts. It's hard to do in fixed income, as you know. Liquidity is not the same, especially when it comes to sourcing bonds. And so that's the challenge there. So that's why in the model delivered SMA space, it's mostly active equity strategies that actually make up a significant chunk of that. Now, on the manager traded space, direct indexing is the largest space. It's about 35% of what's out there. The next space, next vertical is munis. It's about 31 or 32%, and followed by taxable fixed income, another 17%. So those three verticals accounts for about 85% of the opportunity set. Now, what's interesting there is the reason you've seen these actually, especially direct indexing, expand in the manager traded SMA space is because of the trends that we've seen in the space, which is like being able to customize portfolios, manage them in a tax efficient manner, and also being able to transition assets in kind. So I would say the manager traded SMA vertical is really more conducive for those trends because you can actually manage accounts, asset managers managing these accounts on their platform in a much more personalized fashion, applying tax efficient strategies on top of that, and then also providing an ability to help advisors transition assets in kind in a tax efficient way. So, from that perspective, I do think the manager traded SMA space is still where the growth is going to be. Model delivered SMA space would still prevail because there is still benefit in replicating certain models. And but I do think that applying tax overlay makes total sense there as well. So I would say that we would continue to see double digit growth in the managed traded SMA space over the next few years.
You use a rules based system and an algorithm to customize portfolios at scale. What kind of human checks do you incorporate to make sure that everything is working the way it should?
Yeah, no, we have a lot of guardrails. So the rules-based, framework that we have, we apply a ton of guardrails when we're rebalancing portfolios to make sure that the rebalancing itself is actually has checks and bounds. But once we apply the optimization, the results from coming out of the optimizations are checked by portfolio managers before they are executed, Bob. So that check is still there. So we're not really a robo advisor, right? So where we automatically rebalance an account and trade them automatically. We still have checks and bounds where a portfolio manager needs to look at the output from the optimizer, review it, look at the trade recommendations, and approve it. So we have continued to do that for both fixed income and equity accounts, and we'll continue to do that in the future. What we are focused on is really making sure that those guardrails that we apply during the optimization and post optimization are much more efficient, that a lot of the breaks and issues that we would expect to catch are caught by the system itself. So it becomes more efficient for one portfolio manager to manage and review thousands of accounts because the automated checks actually makes it easier for them to catch the obvious issues.
You mentioned Remy. earlier when you were describing your role there at Allspring. Explain what Remy is and what are the trends that you're seeing in terms of how clients are using it, especially to minimize their taxes.
So Remy is our customized SMA platform, Bob, that we built in-house and we launched it in March of 21. And what it really helps us to do is, for me, platforms is means to an end, right? So the platform really provides us a scalable investment platform. It helps us to apply the investment process more consistently across different strategies, and within each strategies, individual accounts. So for me, the platform helps us create scale, right? So the vertical scale and the horizontal scale. So for the vertical scale really means that if you have a strategy, you can customize individual accounts for, and thousands of accounts within each strategy and manage them in a much more efficient way. And then the horizontal scale is that the same platform supports, both active and passive strategies across both fixed income and equities. So that's really how we leverage the platform. And from the advisor's perspective, the platform really helps them do a few things much more efficiently, right? So we use the platform to generate proposals for them when they're interested in investing their cash in an Allspring strategy, or if they're interested in transitioning an existing portfolio in kind over to one of our Allspring strategies. So we leverage the platform to generate proposals for them in a much more efficient way. And then the platform ultimately helps them when we are managing the accounts, is because it helps them helps to deliver customization that they're looking for their clients, and then also deliver the tax efficiency, which is one of the secondary goals of the platform. So that's really kind of how we have been leveraging Remy, and how Remy has been useful for the advisors out there. And in terms of the direction of travel for us, is we are looking to really expand the capabilities and make it like a one-stop solution for advisors in the future when it comes to onboarding accounts, looking for content around their existing strategies, and then also potentially reporting as well for strategies that they onboard onto Remy.
I want to ask about a couple of issues that have come up in the various articles that we've published on our site about direct indexing. I've also moderated panel discussions on direct indexing. So the first one is this: um, it relies, tax loss harvesting relies on the wash sale rule and avoiding the wash sale. And the goal is to replace a security with another one that's close enough to the original but doesn't violate wash sale provisions. The analogy that I would draw there is that it's like a professional football player or a college football player running down the sideline with a ball, hoping that his toe doesn't step out of bounds. But the slightest misstep, the slightest push, and you're out of bounds. And there have been some notable violations of that wash sale rule. I know of one incident where Steve Ballmer, the former CEO of Microsoft, lost hundreds of millions of dollars, or had hundreds of millions of dollars disqualified and what he thought were tax savings taken away. How do you address that issue of having to be so close to stepping out of bounds, but not stepping out of bounds?
Yeah, no, it's an interesting case study, Bob. So from our perspective, that's why my preference is to rely heavily on guardrails, like, really have a platform that is tried and tested, where you apply guardrails in a more thoughtful way. And these guardrails, to your point, are different depending on the asset class, and the rules can be quite different. So it is quite critical from my perspective to really have a platform where you can apply guardrails consistently across thousands of accounts, because that's really what this business is all about, right? You're not just managing a handful of accounts. Every asset manager out there is trying to scale their business and manage thousands of accounts. So to be able to leverage technology and bake in investment acumen through technology into a platform so that you can do this at scale consistently is super critical, to avoid incidents like the way you mentioned, like the ones that you mentioned. So I would say that trying and testing and making sure that it's can be applied consistently across different asset classes, different strategies within those asset classes, and making sure that you are delivering consistent results to your end investors or FAs in this case, it becomes really critical. So I personally think that technology is the solution here, and relying on technology and human expertise, right? The combination of the two ultimately gets you to the finish line.
The second concern that I've heard expressed has to do with the fact that you mentioned earlier that tax loss harvesting benefits primarily ultra high net worth and high net worth investors. And I believe that it also has its greatest benefit for a portfolio that is generating short term capital gains, which typically would occur in a hedge fund or private equity type vehicle. As such, it reduces the tax burden of those very wealthy investors, but those taxes are being paid by someone else, presumably the less wealthy. Does that concern ever come up in your discussions with clients?
I guess not really. I would say we are really focused on maximizing tax efficiency for all clients, Bob. But I think philosophically, what you're asking is really, how do you kind of make sure that you can deliver the same kind of tax efficiency to all, parts of the wealth spectrum, right? That's really the way I see it. Is really, can you provide, or maybe make this whole tax efficiency more democratized, so that somebody with $100,000 portfolio or $50,000 portfolio can leverage the same kind of tax benefits or efficiencies that somebody would gain with a $100 million portfolio. I think you've seen that happen to some extent in direct indexing in equities, because there the minimums have actually come down. I'd referenced this on one of the other calls, where I've actually personally seen like fintech platforms that are trying to deliver direct indexing, for like $100, $200 using fractional shares. Now, obviously, that's a stretch, but my point is, bringing down the minimums in most cases does help, provide that tax efficiency to lower echelons of the wealth spectrum. But I also think that the next iteration of this is to be able to make the overall asset allocation tax efficient, right? How can you actually go from just being able to do this in direct indexing like equities to fixed income and to pretty much all aspects of your asset allocation, is going to be critical in my view. That is the future direction of travel, and I think that's where asset managers and wealth, platforms are really going to be spending the better half of next decade.
You spoke earlier about one of the trends that you see is a gravitation towards manager traded SMAs. What other big trends do you see in terms of the big picture outlook for tax loss harvesting next year or beyond, based on your view of the markets?
Yeah, I would say the one direction of travel is really being able to apply this to more sleeves within the asset allocation framework. So I would say if you look at your model, asset allocation models, the allocation to SMAs, can range anywhere from 4% to 20%, depending on the model. But I would say half of that are maybe tax efficient, the other half are not. So being able to make the entire allocation to SMAs tax efficient would be, I think, critical in my view. And then going beyond that into making sure that the overall tax efficiency of the asset allocation, the entire asset allocation is can be maximized. The other piece is like household based tax efficiency. So if you have multiple accounts in a household, how can you actually maximize tax efficiency for the entire household? So those are two trends I would say that would be that are interesting, and I see asset managers pursuing them, and something that I do think is going to add value to end clients in the long run.
If there's one key takeaway that you'd like to leave with our audience of advisors about how they should evaluate a direct indexing solution for their clients, what would that be?
I would say, kind of you got to, from an advisor's perspective, they're really looking at, not just tax efficiency in a standalone fashion. They're looking at the investment efficacy itself, right? So I would say tax efficiency, even though is a goal, is not the primary goal, right? The primary goal has to be, how can you choose a strategy that that checks the boxes from an investment acumen perspective, performance track records, the asset managers, ability to actually do that at scale across different, account sizes. So I think all of that matters on top of just having tax efficiency, as an additional benefit. So to me, I think the evaluation has to be more holistic than just purely based on if the strategy is tax efficient or not.
Wonderful. Well, we will include some links in the notes that accompany this podcast where you'll be able to learn more about Manju and Allspring and the services that it offers. There's two white papers. One is called Unlock Smart Outcomes, and the other is called Tax Loss Harvesting, Seizing Opportunity in Fixed Income. And there's also a podcast with Manju on mega trends in tax management. Manju, is there anything else you'd like to add?
No, I think we've covered all the key pieces, Bob. So thank you so much for having me. This has been a pleasure chatting about tax management, tax efficiency, and SMEs in general. It's been a fascinating discussion.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Huebscher, today featuring Manju Boraian of Allspring. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.